Hey everybody, hope you're having a great week. Today I want to talk about something that has been asked of me quite a bit lately from clients. And this is my little graph here that I just hand drew. I know it's not very accurate, so just bear with me. But what this is the price of oil, which my marker's not working, but I'll get another one. So price of oil. And looking at where we were not all that long ago at $110 a barrel, with oil trading now at $55 a barrel, a lot of people have been calling and asking me, is now the time to buy? Should I buy oil? And it certainly looks as though if you have a price decline like that, that's certainly better than thinking the opposite of after it's already run up. But this is historically the price. And you can see how oil has gone for periods of 30 years where it really was around, and this is $20 a barrel, where it was around $20 per barrel. So thinking that, don't anchor yourself to the fact that at one time, this is actually in 2007, oil was at $140 a barrel, all the way to where it is now at $55. Don't anchor yourself to this number. Historically, oil has been on an inflation-adjusted basis around this $20 per barrel and could stay there for who knows how long. Now, if you're making a bet, maybe it does make sense. If it gets down to 40 to 45, it might pop and you might be able to make a quick buck. But if you're investing, then it's not really how you do things. All that's doing is making a bet. And maybe it pays off, maybe it doesn't. And if you take 2% of your portfolio and make a gamble on some sort of oil stock or some derivative trade of oil, then maybe that can be okay. But that's just one of the risks associated with investing. It's not that this is a risk as well. Obviously, you can buy something at 140 and it can trade down to 55. But a more realistic risk that people experience in individual stocks or in investing as a whole is you can go massive periods of time, very long periods of time, and not make any money. And this is an example right here from 1998 to 2014. This is Coca-Cola. You literally have made $0, or I think it's about 1%. That is a long time to not make any money on your money. From 1970 to 1993, this is IBM, made no money. 23 years, didn't make a dollar. From 1999 to 2013, this is Microsoft. Lost money over that period of time. That's 14 years. This is 23 years. This is 16 years' time that you've gone and not made any money on your money. And with any individual stock, that can happen. So what you start to do, and even with the S&P 500, that can happen. You went from 2000 to 2010, what was called the lost decade, and made no money. So how you start to manage that is you begin diversifying. And the S&P 500 has a lot less chance of going 15, 23 years without making any money than just one individual security. Now, you might have the similar price volatility, but you just start minimizing that risk over time. It's why you put money in different asset classes and you begin to shrink that. Now you start putting money throughout the world, and that period of time of what might be 10 years for the S&P 500 shrinks to 5. And then you start adding small companies, you start adding emerging markets, and that shrinks even further, and you start to manage risk. It's so you avoid this, a period of 30 years where the price of oil is $20, a period of 16 years where you make no money on Coke, IBM, and Microsoft. So I hope this makes sense to you, and it's just one of the risks associated with investing your money. Not just what can go up and down, and maybe you can lose it all. It's what is the time frame of which I can go where I'm going to have no performance or even negative performance if you look at the case of Microsoft. So call us if you have more questions about this. 770-984-2312. Have a great rest of your week.